So when you get out late and you get back in late, you've compounded your losses. You've locked in the loss on the downside, you've missed the rebound on the upside. And it's really that flip side, that getting back into the market, that's really hard to do. It's easy to get out when everybody's panicking and pull that trigger, but knowing when to get back in is equally as important.
I totally agree. And one of the things I will still emphasize on a little bit is that we're not saying everything is going to be okay if you didn't have the right plan in place. Because if you are in the distribution phase of retirement, and let's just say you had your entire portfolio in the S&P 500 index fund and you let it ride. Well, we all know if you took that ride in 2000 at the beginning of your retirement, let's pretend that was retirement, we all know it wouldn't have been a good, even the survival rate for most people by the end of 2015 and 16. So we're not by any means saying all crashes are okay and all ups and downs are going to be okay. It's about when you have a solid plan in place with the safety net, then you do not time the market. You don't worry about it because that's already been accounted for. I just want to make sure that, if you're listening to this, you understand that. So if we sat together, you sat with one of our advisors and that's already in place, you're in good shape. We don't have to worry about you. But if you haven't done that, not only are you going to go through this in 2022, but you may go through this, God, I don't know how many more times during your retirement. And that's not how you want to really live your retirement, by headlines and news. I could imagine that could be very uncomfortable. And that's something, Rem, I would say that's been our philosophy here at Confidence Wealth for a very long time. Have a safety net in place.
I would say that comes back to risk tolerance very much as well. Knowing your risk tolerance and knowing the downside that you're comfortable with. Nobody's investing to lose money, right? That's not why we invest. But the markets are going to have ups and downs, and we have to be comfortable with some ups and downs if we're going to be invested in the market. If we want those 20% returns that we get in some of those years, we're going to have some of the years where we see some of the downside as well. But putting that in a way where we're comfortable with the potential for that downside is really the most important part, because that's going to keep you from making those knee-jerk reactions where maybe the markets are down 50%, but if we've limited that to 15, 20, and that's within your comfort zone, we're going to feel okay about that, right? So that initial plan and setting that up and really putting that in place for the long term is really going to have a significant impact even on your psyche as we go through some of these ups and downs.
The key to this is not having overexposure in any area that in the end could end up devastating you if the metric for that area goes the wrong way. Nobody can guarantee anything in the world, but what you can have faith in is that the fact that a lot of the things that if they're balanced in the right way, if it goes off for a while, it'll balance itself in the longer term as you go back. And I think that's, again, some of the plans that have been designed for the clients is to avoid that overexposure in one area or the other. It's easy to overexpose, by the way. It's just really common. There is a reason for it. It's a lot of interest by a lot of companies and corporations in promoting their particular brand of whatever offering that they have. So if you are, if you're a company relying on equities, you're going to say, well, equities are great. It's always good. But and you're going to be fine, and they will probably be set at some statistic. The reality of it is that if you're not balanced and if your exposure isn't done correctly, you could end up with a big problem. That's how problems happen. If that is not the case, nobody would lose money. Nobody would have a problem in the marketplace because at some point it all balanced out. The reason there are issues is because there's no balance. And I think that is the thing you can take comfort in, is that there's balance in the design of the portfolio at Confidence. The team works very, very hard at understanding you, understanding how you're thinking, what do you want, what are your objectives, and see if we could balance that out in a way that gives you lesser exposure as bad things happen, because bad things will always happen. We're not going to stop that in the world. So, Chris, any thoughts on that?
Yeah, Raymond, I think you hit the nail on the head. When you talk about overexposure or overconcentration, we always preach diversification. The other thing we talk about is matching your risk tolerance to the risk of the portfolio. So there's very few clients that the S&P 500 is the perfect reference point for, but that's the thing that the talking heads are always referencing, right? Is the S&P 500. If you have a 20% equity and an 80% bond portfolio with us, then only 20% of your portfolio is in equities. And so that S&P 500 that's down 10%, that's only down 2% for you, right? And plus whatever the bonds have done, the bonds is usually up a little when stocks are down. So just watching what the S&P does is really not healthy for the client that isn't 100% S&P. You have fear of missing out. You have S&P envy when the S&P is up 30 and you're only up 10. But when the S&P is down 30 and you're only down 10, then you feel a little bit better about it.
And by the way, if you think that this is a psychology that's only exclusive to you, it's not. Because when I say you, anybody who's listening to this, because even big corporations sometimes end up over sort of betting on things, and they end up with a problem, as it happened in the last crash when COVID started. There are many examples of corporations that actually lost tons and tons of money because they bet too heavily on the market. And even when COVID hit, they pulled out of the market, even at that point, even at their level of supposed expertise. They're institutional investors, and they end up losing significant chunks of money when the market picked up again by not doing that. So I think that goes to the conversation we're having, Chris, is that it's, you never know. It's not simple to go out there and trying to predict this. And there's always somebody want to tell you that you should be just pulling out and hanging in there. And in most cases, that those people are sort of taking a gamble. They're going to say it. If it works out, they say, see, I told you. If it doesn't work out, they disappear just as if nothing happened. And then guess who's left holding the bag would be necessarily the client.
That's a great point, Rem. And I can't tell you all too often. Everyone wants to talk about their winners, right? So when you're having conversations with friends, neighbors, family, you're not getting the whole picture usually, right? I can't tell you how some of my previous firms where you see the whole account, all they want to talk about is that one winner up at the very top. They don't want to talk about the 9 losers that they have down below, right? So just because somebody has one, magic bullet that they said was the greatest thing, they're not giving you the whole picture, right? And they also don't know your circumstances. They don't know if you have a plan in place and the other pieces that do work together like that. So all the noise out there, again, you kind of have to take it with a grain of salt, even if it's good information, right? Even if it's valid and it certainly fits that, it's still good to kind of trust but verify, right? And do your own research. And we're here as well, right? Questions, concerns, we're certainly here to help and make sure that you feel we're confident. Confidence wealth management. We want you to be confident in your plans for the long term. So we're here to help.
And the big thing here is that one of the things you're trying to do in this particular roundtable is give you an idea of what we are doing and what the markets in general are doing and how does that relate to you. It is important to always keep in mind that it is the balance, which is the crux and the foundation of the plans that you have. And you have it. If you're here with us and if you're doing something in here in terms of your planning with us and you've done it, then it's been over the years, over a number of events that happened historically in the recent 2 decades, we've seen that those plans held up very, very well. So this is not a new thing for us in here at Confidence. And we've done a lot of work in that area to make sure that we balance portfolios in a way that is relevant to your situation. So you can have that confidence. You can have that sense of safety in a sense that things will somehow eventually, even if things turn, that they'll be okay. Nobody in the world can guarantee anything, as I always say, and we always say that there's no guarantees. But we do know that if it's a solid plan, if it's balanced correctly, you should be able to weather storms like a ship that is sturdy and solid. It could get wet, but what you want to avoid is it being capsizing. You don't want a boat that is fast and going to get you somewhere, but is going to fizzle as soon as there's a little storm. You want something that's solid that can take you through.
Well, one of the things we always talk about is we're not here to give you an exciting roller coaster ride, right? We want to make the ride as boring as possible. And that's why you have to be really careful about those roller coaster hypes you do hear, kind of like what Chris talked about. I thought that was a very good point, and I don't want that to go missed, is that all the conversation is always about just the equity market, as if someone is 100% in the equity market. And realistically speaking, even when you look at Warren Buffett, you can't say every single thing they have is in equity market. Even the biggest, billionaires have diversification. They have real estate and they have other things. So that really plays into the fact that you have to be really careful of where you're getting your news, what they're saying, And truly, what does it mean to you when it comes to your plan? And we keep saying we're back, like James said, a broken record of plan, plan, plan. But that's why a solid plan in place is one of the most important things you can do. Now, we also know, maybe this will be possibly a little bit of a bumpy ride in 2022, but that's why you got the seatbelt, right? That was your safety net. That's why you're okay. We know how the ride is going to look like. And the most important thing is also just knowing that things are not going to look exactly like they did, during the last 5-6 years. That's something, Chris, maybe we talked a little bit about that at our investment committee meeting. Is really the 60-40 fund or the 20-80 fund going to do what it's done the last 5, 6, 7 years in the same way? Probably not. And maybe you can emphasize a little bit on that so people are prepared and they understand how it's going to look a little different than it did the last few years.
Yeah, we've had a really strong run the last 3 years. Equities have been up double digits. If you've been in, if you've had a big position in something like technology stocks, they're up 30-40%, some really, really strong numbers. So even fixed income has seen some high returns over the last couple of years. Typically, we think about projecting over the next 10 years, equities, something like the S&P 500 might return 6 or 7% per year. We've been doing, in some cases, 2 and 3 times that. Mm-hmm. So in theory, we're going to have years where the S&P 500 is going to be down 10% or flat. We're down 20%, right? That's the sort of that long run expectation. But we should enjoy the good years, right? We can't expect that every year is going to be these record-setting years. But when the market is down 10%, we should also not panic, because if we look back over the last 5 years, we've still done really well. If the Fed raises rates and your bond portfolio is, all of a sudden down 3 or 4% in the short term, over the last 5 years, you're still up. I'm going to make up a number, but you're up 4 or 5% per year, which is probably above the long run average. So it's just simple, like we always say, zoom out, right? Don't look at what it's done this week, this month, this quarter. If you have a plan, James talked about the Monte Carlo simulations, and the great thing about Monte Carlo simulations is it's mathematical, but it's random, right? It's scientific randomness, these Monte Carlo simulations.